We can start now while others will join. Good evening, everyone. I want to believe that you had a great day. So the last time we met, we discussed audit evidence and sampling. And I want to believe that the last class you had last week was on maybe test of control or internal control. Okay, so I will be taking us through substantive procedure, introduction to substantive procedure. Now, I would like to confirm, have you had this topic, text of control, or what was the topic you had last week? Can anybody just answer? What topic did you have last week?
Internal control lang.
Internal control. Okay, that is fine. No problem. Thank you for responding. Okay, so I'll be taking us through introduction to substantive procedure. But before I do, I need to give some overview. Okay, what do I mean? So, substantive procedure are part of the audit test, okay, that are performed, okay, in order to ensure that the audit evidence to be gathered from the client's business environment are accurate, okay, or from the client's business environment are not with any material misstatement. So there are two tests you need to perform, because I want to be that when you had internal control last week, you had what is called tests that need to be performed in order to be able to place reliance on the internal control system. And those tests that you need to perform, we call the two tests, test of controls and test of detailed transaction. All right? There are two tests to be performed for you to be able to place reliance on the client internal control system. You have to do two tests. The two tests are test of controls and test of detailed transaction. All right? Now, the other one, which is a mix of the second one, the later, is substantive procedure. All right? Now, substantive procedures are procedures or audit procedures performed to detect, okay, to detect whether there are what material misstatements in the what in the financial statement presented. All right, there are procedures performed in order to detect whether there are material misstatements in the financial statement presented. All right, so it's a combination of test of a transaction and analytical review procedures. Okay, test of detailed transaction and analytical review procedures, right? Now, remember I said that there are two tests to be performed before you can place reliance on the client internal control system. What are the two tests? Test of controls and test of detailed transaction. What is test of control? Test of controls are controls or are tests that are carried out in order to assess, okay, in order to assess the efficiency and effectiveness of the client's internal control system. Okay? Efficiency and effectiveness of the client's internal control system. All right? Now, on the other hand, the test of detailed transaction are tests that are performed, okay, in order to verify the accuracy and completeness of financial transaction. Okay, there are tests that are there are tests, okay, audit tests, right, that are performed to verify the accuracy and completeness of the client financial transactions. Okay. Now, let me explain how this test operates or how this test work. Okay. Now, in the test of control, what you do is that you are going to ask, you are going to deploy different methods. One of the methods you can use is to do what? Is to ask the client management. How do you ask them? You sit them down and you interview them. Ask them how do their business processes operate. All right. Now they will explain. While explaining, you are jotting down. Right. That's what you do when you are talking about narrative notes. Okay. You jot down. Now, another way you can use to test for your control is to use the internal control evaluation questionnaire or internal control questionnaire. Now, what do you do? So the internal control questionnaire, internal control evaluation questionnaire are questionnaires that are designed, okay, along the client's internal control system. So the responses to those questionnaires will form the basis for the auditor to conclude whether the internal control system is strong or the internal control system is weak. All right? Because the set of questions you have in an internal control questionnaire are open-ended questions. That is, you just ask yes or no. Okay? Most of the questions are what? Yes or no. So after you receive the questionnaire, right? You are now going to analyze their responses, the feedback. So where you have more negative than positive, it has an implication, or vice versa. So that's how you are going to test whether the internal control system is weak. You are not checking anything as at that time. You are just trying to get information as to whether you can rely on the information that is generated or the audit evidence that can be generated from the client's internal control system. Okay? Now, the fallout or the results of that test of control will go a long way in determining whether you are going to proceed to carry out the second test of detailed transaction. All right? Now, the essence of the test of detailed transaction is for you to be convinced beyond any reasonable doubt that the client's internal control system is efficient or it is not efficient. You understand? The client internal control system is efficient or it is not efficient. Because you are trying to clear that doubt about the effectiveness and efficiency of the client's internal control system. Okay? Now, in this test or procedure, what you do is that you are going to take a step ahead. So you select some transactions and you are going to place them on the information that you have gotten or you derived from the client management to be sure that that information that you got can be relied upon or not. So for instance, in the test of control, you ask, do you have an accounting policy in your organization? And the answer, yes. So when you are doing your test of detailed transaction, what you ask is that, can I see the accounting policy and procedure? Can I see the document? Okay? But you're not in the test of control, you're only asking them. You are not asking for proof. But in the case of test of detailed transaction, you are going the extra mile of what? Asking for what? Proof. Okay? Number two, in the test of detailed transaction, you are going to verify transactions. How do you verify transactions? So if somebody has put in the ERP in the purchase ledger or purchase schedule, an amount, let's say they put an amount of 50,000 naira. You have the payment voucher reference number is there. Okay. You can see the description. You can see the chart of account or the account code where that posting was made. Right? So what you do, you now call up that transaction, the source document. You would like to see the source document. That is the source document will show, for instance, in an organization, it varies from organization to organization. But what is common practice is that most organizations will have what is called requisition, purchase requisition. Okay? So before you incur any expense, you must fill that purchase requisition. And that purchase requisition must be signed, right, by the what? User department. Okay? So after the purchase resolution has been signed, the next thing for you to do is to give it to the accounts department. Okay? They are going to raise what? It could be that way. Like I said, it varies from organization to organization. So if you have some organizations, they give it to account department, they will make payments. Okay? If it's a already known vendor or supplier. For instance, you want to pay for your internet subscription as an organization. These are already known suppliers. What do you do? It's a recurrent expenditure, right? Every month. So what do? You are going to raise the requisition, right? After raising the requisition, what do? You now give it to the accounts department and do what? And make payment. Okay? Once you make payment, the service provider will issue you the invoice together with the what? With the receipt. Okay? Then that is a closed transaction. But on the other hand, you want to go and buy maybe stationery. What you do is after the purchase resolution has been signed, you give it to the procurement department. They will go and get, because it depends on the organization. Some organizations will say that you must get at least 2 quotations. So you go and get 2 quotations from the market, and you're going to do what? Price comparison. So based on the maybe price or quality, you're going to take one of the 2 vendors. Okay, you bring the both quotations to the accounts department, attach to that purchase requisition, where the account department will now raise what? A purchase order. I hope you can relate to what I'm saying. Am I communicating? Hello, class. Am I communicating?
Yes, sir.
Okay, thank you. So, yes, Alexa, any issue?
So this requisition, is it same with a voucher?
Now, requisition is what you are going to raise, first of all, that will now be attached to the payment voucher.
Ah, but who will
Yes.
do the voucher then?
Now, is after the purchase order has been raised, right, by the procurement department, they will now send to the accounts department. The accounts department will now raise the payment voucher that they will use to make payments.
Okay.
Accounts department raise the payment voucher. Is that clear, Alexa?
Yes, sir. Yes, sir.
So it's the account that will raise the payment voucher. Now, the end of the payment voucher is that they want to incur an expense. They want to buy something. So is that payment voucher they are going to raise. Depending on organizations, they will rather do transfer to the supplier, or some, they will raise what? Checks, bank checks. Okay? They will give the customer checks that this is what they want to buy. With the check, they will allow them to do what? They will go and catch the check, and they will allow them to what? To take whatever they want to take on behalf of the company. So that's the process. Now, why I'm saying this process is that These are some of the highlights of what the auditor will do when he's using the test of detailed transaction. These are some of the processes or procedures you will need to what? Follow through. Check. You take a sample of some of those transactions and verify that these transactions pass these stages. Okay? I hope you are getting it. So that is what the auditor will do. I'm talking of the external auditor. Now, where does the substantive procedure, where does that come in? Now, substantive procedure will now come in when you are trying to do what? You are trying to establish that there are no material misstatements in that particular transaction. So you look at these stationaries that they bought this month. How much did they buy it 3 months ago? For instance, you bought stationery last month or 3 months ago, you bought it for what? 50,000 naira. Let's say A4 paper. Okay? Now, this month, you are buying it for 70,000 naira. Now, the auditor will want to see why is there a surge or an increase in the price from what you bought last time and the current price. So when you are comparing the last price of purchase and the present price or the new price, you are doing that comparison. It is an example of what? Analytical review procedures. Because analytical review procedures shows what? Possible relationship between financial and non-financial data. So let me explain it now. Now, anytime you are trying to make comparison, sometimes you want to buy something, you take it to your budget holder or the head of department that you want to incur some expense. What do you normally say? They will ask you that, let me see how much we bought that thing last time. When they're asking for that, they want to be sure that the person that's going to make the purchase is not trying to change the organization. It's not trying to rip off the organization. It's not trying to defraud the organization. So most times when there are these variances that are glaring, there could be pointer to the fact that there might be some material misstatement in the financial statement. So that is why you see that you look at the statements or the financial statements in line with IFRS, you see that they always have comparative balances. What do you mean comparative balances? Go and check your statement of profit or loss, other comprehensible income. Go and check your statement of financial position. You have the previous year and the current year. You always see it there. Both of them are there. Okay? So why are they there? So that if you detect any variance that is beyond normal, right? You can quickly what? Take it through and try to find the reason for the what? For the variance. I hope it's clear. So that is what we mean by the substantive procedure. That is the combination of what? Please mute your mic. The combination of test of detailed transaction and analytical review procedures. Please mute your mic. Mr. Udopong, your mic is, you need to mute your mic, please. Mr. Udopong, mute your mic. Okay, so let's continue. With that clear, I believe that everybody is clear with that now. Okay, so ISA, please mute your mic. Mr. Edo, mute your mic. Mr. Anyekeme, mute your mic. The noise is interrupting. That's why I'm trying to. This thing is interfering with us. Let's continue. Okay, as I was saying, so that is the brief explanation of test of control, test of detailed transaction, and substantive procedure. And remember, the purpose of this class today, we are looking at what? Substantive procedure. Okay? Now, what you also need to realize is that the output or the result of the substantive, the result of the test of control, like I said, will determine to what extent the substantive procedure will be what? Will be carried out. So let's say, for instance, the test of control shows that there is high or there is a reasonable level of assurance on the financial statements. Okay, that means the auditor will do less work on what? Test of detailed transaction and analytical review procedures. But where the reverse is the case, they will need to get more audit procedure,
So
carry
it's
out
gonna
more
mute
audit
those
procedure.
people, sir.
Alexa, what's the matter?
They are too noisy, no?
The noise, that is it now. The noise is too much. Mr. Anyekeme,
Excuse me, sir. Can you just kick him out? Once it's out, he will log him back. Maybe it's not with the phone. I don't think.
Let me try and see if I can move him out. Sorry, because it's distracting us so much.
You didn't tell me to be sure for the podcast. You know, I get so good. Yes, but we didn't. Just continue. I want to know where the online is on that part.
I can't do it.
That one, sir, I can test it in I can.
I can't do it.
The one that they are discussing.
I can't. I'm trying to remove it. I can't remove it.
You can do it.
The noise is
Why not we log out and then come online
okay,
again?
let's log out.
That is the best. Yes, that is the best.
Let's log out. Let's log out and log in.
So if I look at this in US, they've gone from 5.9 to 5.3. So they have the loss of
Still the same thing.
The guy is still there.
multiplied by something to get something. When you have said that, when you have compared this one report, the average amortized cost plus
This thing is really disturbing us.
15.9. They compared 6.4.
I wish I can remove him. I can't remove him. Let me speak with Mr.
So you have compared the care content situation to the final situation. And at that point, you only have the bill.
Good now.
So you're not taking accounting for the bill. And listen, that you only have the most nice that the entire one you have done. That you have been comparing. You have been comparing
You
life for life.
big person.
Life for life
Your
means
mic,
that
please.
you start, you do a calculation for CBSC. Understand what has happened. So that you know what the calculation bill activities.
Who be this
So
person?
you don't have a bill. It's a lot of 5 million years. 5 million years.
Naso.
So what is this that fair value is? I don't even fair value. What is that? This is the solvency. They go from 5.9 to 3.9. So they do have the same million. But they don't have shown it. They're not showing the rest. Because I showed them where it's 6.4 billion, the 8.7 billion. But 6.4 billion that are considering other things, and we have already translated this at 15.9. Meanwhile, this 5.9 initially was at 9 billion. So inside this room, conversation is a game of 151 minus 9,000 multiplied by something. So we are mixing up FX inside the indication game. Indication game is putting and down the contracted. So that's the thing. Your first final amount is 5.1 million. What we got in the indication case, whereby we are having a lot of people speaking, so you have the same here. But you have to account for the other place that happens. You understand? That's the one where you cannot do at all. When I come here and say, oh, 5.6, this is 5.9, when I'm saying we got some about, when I'm saying the new assets that we acquired, in fact, I will first do this for just, and this is an amortized cost conversation. So at no point can I bring in 8.7 billion here. Because 1 billion is not amortized cost. That's in 2.9 billion.
The person is Edo Pong. Thank you. Thank you, sir. Okay, let's continue. Sorry for that interruption. Okay, I was trying to confirm that I think with that explanation, it is everybody is clear on test of control, test of detailed transaction, and substantive procedure now. Are we cleared? Are we cleared?
Yeah, clear, sir.
Okay, so let's continue. So, like I was saying, the more assurance that the external auditor gets from the test of controls, the less the work is going to carry out on test of detailed transaction. Okay, the less is going to do, and vice versa. Okay, all right. Now let's continue. Now, when you talk about substantive procedure, what we need to know also is that, remember, when we talk about the audit evidence and sampling, I made mention of financial statement assertion, and I explained further what they are. Okay. Now, that explanation we had in audit evidence and sampling, we are going to make use of it here when you talk about substantive procedure. Because substantive procedure, like I said, is a detailed procedure that is performed in order to detect if there are any material misstatement in the what? In the financial statements. That is the essence of the substantive procedure. Okay. Now, how can you be sure that the financial statement does not contain any material misstatement? Then you are going to subject it to the financial statement assertion. All right? You subject it to what? Financial statement assertion. So I will recap again. What are financial statement assertions? These are statements made by management, okay, regarding the financial statement that has been presented to the auditor, explaining that there are no material misstatements therein. So the essence of the financial statement assertion is to make the management to confirm that the financial statement they presented to the auditor is free of any material misstatement. So what will the auditor do? What will the external auditor do in that regard? The second editor will now do what? We now carry out, we now test those assertions, whether the assertions are true or false. Okay? Now, if the assertions are true, then it means that there are no material misstatements in the financial statement. And where the assertions are false, okay, after the editor tested them and they are false, that means that there are material misstatements in the financial statement. So we need to understand that. All right. Now, the assertions, the financial statement assertions, they are of three types. We have assertions based on transactions and events. We have assertions based on account balances. We have assertions based on presentation and what? Disclosure. Okay? These are the three types of assertions that we have. Assertions based on transactions and events. Assertions based on account balances. Then assertions based on what? Presentation and what? Disclosure. What's the difference between the three of them? Now, in using substantive procedure, right? The first assertion based on transactions and events, relate more with what? With your statement of profit or loss and other comprehensive income. Assertion based on transactions and events relate more with what? Statement of profit or loss and other comprehensive income. So all the auditor will be doing is that he will not be testing these assertions to be sure that the information for the figures that are contained in the statement of profit or loss are free of material misstatements. So what are the tests we'll be carrying out? You carry out tests on what? Occurrence. Occurrence is that all the transactions that are contained in the statement of profit or loss actually occurred. They are not fictitious. They are not fake. Actually occurred. For instance, stationery, right? If they buy stationery will come under what account code in your financial statement? You come under what? Printing, right? Printing and stationery. That's the account code for you use for posting your what? Stationery. So the auditor will now ask for what? Documentary evidence. Where is the invoice? Where is the invoice of the stationery that you bought? The auditor will check that invoice, right? With the what? With the goods received note. If you have bought that thing as claimed, right? The auditor will see that they have attached what is called a goods received note. What's the essence of the goods received note? The essence of the goods received note is to indicate that upon the purchase of that item, the item was delivered and received into the store, into the company's store. That means that the transaction is genuine. All right? That is the occurrence test that the auditor will do. Is that clear? Completeness test the auditor will do is to be sure that there are no transactions or events that have been what? Omitted. There have been no what? Transactions or events that have been what? Omitted. For instance, we have what is called accruals. And you have what we call what? Provisions. Now, these accruals and provisions, right? Sometimes we don't have documentary evidence immediately. So what do? You have to provide for them because you have already incurred them. Or some, you are still going to incur them. In the case of provision, you are still going to incur it. So what do? You make provision for it. You account for it. Okay? So the auditor will now be testing that all of these your transactions, right? They have been what? They have been posted. None has been what? Omitted. Okay? Now, transactions can be omitted in a way that the documentation for that transaction is not complete. And if the documentation is not complete, sometimes you cannot post them because there are some information that will be contained in the supporting documents that you need to key into the what? Into the system, into the accounting system for easy what? Easy referencing. For instance, you want to buy stationery now. Okay? You want to pay or you want to pay for NEPA, your electricity bill, right? Now, if you don't have the bill, you can provide for it. Okay, you can provide for it. Okay, now that one is even better. Now, let's say you made some purchases. You wanted to buy machinery, but they have not taken delivery of those machinery that you imported. How do you account for that in your books? Do you know what I'm saying now? Because as at the time, if they've not supplied it, they cannot include the what? The packing list. The packing list of that asset. They will not, of that machine, they will not send it to you if you have not made full payment. So how do you account for it? Or sometimes they will have even supplied the machinery or the equipment, but they forgot or the company forgot to what? To request for the documentary evidence, the packing list, the certificate of origin, the shipping charges, all those things, they refuse to collect it or they forgot to collect it from the importer. So if you don't have those information or that information, there's no way you can post because you need to be specific as to some of these transactions. You need to make clear presentation. So that is what the auditor will be testing under completeness. There are instances also that there are some transactions that will require you to attach LPO, but you did not attach LPO. That transaction or that documentation is not complete. That's another thing the auditor will be testing. All of these, the auditor will test them under completeness. Okay? The other thing the auditor will test under this assertion, the first assertion, that's assertion based on transactions and events, is what? Accuracy. Data will test for what? Accuracy. That is the figure that you have put, you have inputted on the system, on the ERP or the accounting system is what? Is correct. For instance, you want to write 53, you now put 35. That should not happen. You're supposed to put 35, put 35. You're supposed to put 53, put 53. Don't go and transpose 53. Don't turn 53 to 35. That will mean by accuracy. So later we test all of that. Another thing later we test is what? Is cutoff. That is, those transactions that have been posted, do they occur in the correct accounting period? Do they occur in the correct accounting what? Period? For instance, revenue. In your IFRS 15, revenue with contract, what does it say? The revenue can only be recognized when it is what? When it is earned. When it is earned. There are certain procedures that need to be completed. There are certain obligations that need to be completed. We call it performance obligation before you can recognize revenue. So, for instance, your customer paid money in advance. Will you classify that as a revenue while you have not supplied? Hello, class.
No,
I'm asking a
sir.
question. Yeah?
No,
Good. Why are you not recognizing it as revenue?
because you never supply goods to them now. So it treat like it's liability to your customer.
Okay, it's a liability. Thank you very much. I hope everybody is clear. Are we all in agreement? Are we all in agreement?
Yes, sir.
Yes, sir.
Okay,
Yes, sir.
good. So you understand what I'm saying now? Later we check all of that. So if you pay money in advance, if your customer pay money in advance and you have not supplied them, You cannot recognize that advance payment as what? As revenue. It is a liability. Until you supply the customer with the goods and the customer confirms that he has received those goods, that is when you can recognize that advance payment as what? As revenue. So the auditor will be checking for all of this. Another thing the auditor will be checking again under this assertion is the classification. Did you post into the right account code? The right account code. Did you post into the right account code? For instance, if you work in manufacturing, if you work in a manufacturing organization, right? You have two types of wages. You have direct wages and you have indirect wages. Okay? Now, indirect wages will form part of what? Admin, that is a staff cost or admin cost or salaries and wages. While your direct wages will form part of what? Cost of production. Now, if you take direct wages as supposed to have been added to the cost of production, you now post it under what? Under admin cost or under salaries and wages. Then what you have done is that you have misstated the what? The wages transaction. You did not post it to the correct account code. So all of these are what the auditor will be testing under the assertion based on what? Transactions and events. I hope we are all together. The second one, assertion based on account balances. Now, account balances are found in what? In your statement of financial position. Remember when you're doing your T account, ledger account, balance brought down, balance brought forward. That balance brought down, that balance brought forward is what you post to your what? To your statement of financial position. So the second assertion the auditor will be testing is assertion based on account balances. Remember, the first one, I said that is based on what? Transactions and events. But in this second one, assertion, the auditor will be testing the assertion on what? Assets, liabilities, and equity interest. Because these are the components of your what? Statement of financial position. I take it again. The auditor will be testing assets, liabilities, and equity interest based on these assertions. So the first one is, the first assertion the auditor will be testing is called existence. What is existence? The auditor wants to check that those postings, you have those balances you have posted as assets, liabilities, and equity interest, right? Actually exist. The auditor wants to check that what you have posted in the statement of financial position actually exist. Okay? That they exist in the accounting period, right? Another thing the auditor will be testing is right and obligation. Two things the auditor will test. When you talk about rights, right is to assets, while obligations is to liabilities. What is an asset? What is an asset? According to the IFRS, an asset is anything that is used to generate what? Economic benefit. Anything that is used to generate economic benefit is known as what? Asset. Right? So the auditor would like to check whether what has been recognized as assets truly belong to the client. Because IFRS 16 that talks about leases has a different way of what? Recognizing assets on lease in your statement of financial position. Okay? As a of recognizing assets on lease in your statement of financial position. So for instance, but I mean you are using a tractor, okay? Because we are talking about an agro-allied business. You are using a tractor. The tractor does not belong to you. You have leased the tractor. So what the editor will be looking for in your book, because it's a lease asset, is what? Is the lease rental that you pay. What the editor will be looking for in your statement of financial position under your asset is your what? Your lease rentals that you pay. Okay? You cannot put the total cost of the asset because you are not the owner of the asset. If you do, that means when the relevant tax authorities detect it in your books, they are going to charge you heavily as taxes. And by the way, if you do that, you have misstated your what? Your statement of financial position. Do you understand? Now, another thing the auditor will be testing under that asset is to be sure that you are the owner of the asset, the proof of ownership. If the asset is a leased asset, right? The auditor will ask for what? The lease agreement. The lease agreement that gave you the right to use this asset. In the case of obligation, the auditor want to be sure that those obligations are being what? Are being fulfilled. For instance, you take a loan from the bank as an organization. The auditor will ask for what? The loan agreement. The auditor wants to know whether the loan actually exists or not. The auditor wants to know how much is the loan, what is the duration of the loan, what is the repayment period. These are the things the auditor wants to check to validate or to confirm that these liabilities do exist and they belong to the what? To the organization. Okay? The third one, the auditor will test under this assertion based on account balances is completeness. The auditor will check that no asset has been omitted, no liabilities, no equity has been omitted from the statement of financial position. I've explained that before. It's like you bought a car from the US as a car that will use it to support your business. But because you have bought the car, the importer is here to give you the what? All the documentation for the car, the custom papers, the other documents that you need. They have not given it to you. So in a way, you'll not be able to recognize it in your what? In your asset schedule. Do you understand? So that is what the auditor will be testing, that you have not omitted any asset, liabilities, or equity interest. Another thing the auditor will also be testing is valuation. IS 36 talks about what? Impairment. And impairment is saying that at least you must test your assets at least once a year against impairment. That is, the carrying amount should not be lower. Okay? So you test for impairment. So if the auditor checks the financial statement, especially the assets, and discover that there is no evidence or there is no proof that they have carried out impairment test, then it means that the balances, the carrying balances or the carrying amount in the student's financial position is either overstated or understated. Okay? Either overstated or what? Understated. Okay. So these are the assertions the auditor will be testing under the assertion based on what? Account balances. I hope everybody is clear. I hope we are clear. So we go to the last one, the last assertion. That is assertion based on presentation and disclosure. And like I said, this one relates to both of them, both statement of profit or loss and statement of financial position, both of them. Because if you look at these two financial statements, you always have some disclosures, okay, and you have some presentation about them. There are recognized way to present your, or there are acceptable way to present your what? Your statement of profit or loss and your statement of financial position. And you can't arrange them anyhow. Okay? Then your disclosures also, there are some transactions in this financial statement that you need to disclose. And that cut across either the transactions in your statement of profit or loss, or the account balances in your statement of financial position. Okay? I hope it's clear. All right. Any question? Any comment?
Nothing, sir.
Okay, that's fine. So let's continue. The next thing we are going to look at under substantive procedure is use of audit software. And that will come under what is called computer-assisted audit techniques. Computer-assisted audit techniques. Okay? What are computer-assisted audit techniques? Computer-assisted audit techniques are computer-assisted audit techniques are computer programs that are used by the auditor to obtain audit evidence from the client system. To obtain what? Audit evidence from the what? From the client system. To obtain audit evidence from what? From the client system. So you use computer programs, okay, to obtain audit evidence from the what? From the client system. That is CAT. And there are two types of CAT. You have test data and you have what? Audit software. Okay? Are we together? So let's look at them one after the other. The first one is audit software. What are audit software? Audit software is a computer program used by the auditor to extract information from a computer-based information system for use in the audit. Okay? And there are different types of what? Audit software. Basically, there are three types. You have the interrogative programs, which are used to access the client files and record and extract data for auditing. They are what? We have the interrogation programs that are used to access client file and record and extract data for what? For auditing. What does that mean? So, like I said, they are set of computer programs. So, for you to be able to use audit software, you must understand structure query language, SQL. You must understand structure query language. Why do you need to understand structure query language? Because your computer do not understand simple English. You can only interact with your computer when you understand high-level machine language. Okay? The only time you can speak, you can interact with your computer is when you use what? High-level machine language. Okay? So when you understand this, you'll be able to extract client files and record, okay, for auditing. The second type of CAT, or the second type of audit software, is called interactive software. These are mostly used in online IT systems. For instance, you log on to AliExpress, you want to buy something on AliExpress. There is a pop-up box that will come up. That pop-up will be asking you questions. It will first of all greet, good morning, good afternoon. How can I be of assistance to you? And the thing will try to engage you. Okay, it's a bot. Okay, it's a robot. So it's a bot, a chat box that is designed to ease your what? Your maneuvering or your navigation on the AliExpress or any other website. Okay, there are some banks also that they have this chat box installed when you move on, when you try to navigate on the bank website. Okay, so it's called what? Interactive software. The third one is called resident code or embedded software. These ones are installed on the client system, like software. They are installed on the client repository, that is the client server. What does this do? What is done? That's what they call it embedded audit facility. That is, it is installed so that as transactions are being processed, right? The program has been set up to keep a copy of those activities in the system for the auditor to what? To review. Because they have configured the audit software in such a way that it records all transactions online real time as they are being processed in the what? In the server. Okay? So it's very fast. I hope it's clear. Now, those are the audit, that's audit software, all right? Now, we also have the CAT, the test data. To come back to look at this question. We also have what we call what? The test data. Now, the test data is different from audit software. Audit software is mostly used for test of detailed transaction and substantive procedure. It's used mainly for what? Test of detailed transaction and what? Substantive procedure. However, test data is mostly used for what? Test of control. You use test data for what? For test of control. So what does that mean? So how the test data work is this. You can only apply it on one procedure, one procedure and any other one after the other. You cannot apply it on everything. Unlike the audit software, they can apply it on everything at a go. So you can only apply it per procedure. Okay? So for instance, you want to check if the inventory balances is correct using the test data. What it will do for you is that you first of all pull out the inventory balance report manually from the system. Okay? The next thing I'm going to do is to write syntax, computer program or computer syntax. Okay? Asking the same accounting system to generate or to extract the inventory balance as at a particular period Yeah, in the first one, you just use the what? The ERP to generate. You just click and you generated the what? The inventory report or inventory balance report. Well, in the case of test data, what you do is that you are going to write the syntax, that is the program, such that it will extract the information from the server, okay? And you're not going to compare your output with the already predetermined output. If they are the same, it means that the internal control system is efficient and is effective. But where there are variations, the accelerator will probe for that and try to reconcile those issues, and the procedure continues. Okay? So test data is mostly used for what? For test of controls. Why audit software is mainly used for what? For test of detailed transaction and substantive procedures. All right? I hope we are together. Let's continue. So, like I said, there is a question here. Okay? Look at the question. They said you have been put in charge of the audit of inventory at Kitchen Magic, a wholesaler of kitchen goods. Kitchen Magic keeps a permanent record of inventory on its IT system and carries out a rolling program of inventory count to check that the records in the system or the record on the system is reflected by actual goods held. The year-end inventory will be listed for you showing for each product, date of last purchase, date of last sales, cost, selling price, quantity, and year-end valuation. This schedule will be available on the last day of the year. Required, list the test that will be performed by audit software that will assist you in your audit of inventory. Okay? In the audit of what? Inventory. So the answer you go, this is how you go, this is how you answer the question. First thing you need to do, you need to cast the year-end inventory schedule. Cast here means you need to add up, you need to aggregate. Then the next thing you need to do, list all items over a preset amount, at least the materiality threshold. A preset amount, the materiality threshold. Remember that time when we talk about materiality, right? Then the next thing, for each item on the schedule, multiply the lower of cost and selling price and quantity and list out any item where the figures does not agree to the year-end valuation. Okay? Then you're not going to compare prices to those on the current sales price master file. So what are you trying to check? You want to be sure that they have not tampered with the what? With the selling price. Okay? Because if they tamper with the selling price, you wouldn't know. If you don't carry out this procedure using cards. Because you are talking about millions of transactions. How do you check it? The only way we can check if there are anomalies there is to deploy what? CAT, computer assisted audit techniques, audit software. Just deploy it and you'll be surprised to the extent to which it's going to extract all those anomalies. Okay? Next thing you're going to do is to compare prices to those in the current sales price master file. All right? List out any item where the date of the last purchase was more than, say, 1 month. Okay? As this will indicate that the product is obsolete or no longer in vogue and may be and may be what? Written off. Okay? Written off. All right? Then the next thing you need to do is list out any item which do not appear on the post-year end sales listing for the first month of the year against what? Against any provision made. So what you are trying to do is that you want to be sure that the closing balance, okay, for the year end is the same as the opening balance for the coming year, because there might be some disparity if it's not properly reviewed. Okay? Note that if these tests were being carried out manually, then only a sample will be checked. Due to the what? The speed of computer software, it is feasible to check all items. There's a limitation when you try to do it manually. I talk about having millions of transactions. How many will you be able to detect or track manually? It will be very, very impossible. Okay? I hope that is clear. So that is the answer to that question. All right? So what are some of the problems of using all this software? Number one, it is very, very expensive. It is what? It doesn't come cheap. Number two, constant updates do affect transactions or do affect the running of the what? Of the software. Constant updates. It's like you are trying to shut down for the day and your system tells you 1,000 of 1,000 installation left or updates left. What do you do? That means at that point, at that material point in time, there's nothing you can just have to wait. Okay? The number three, there may be problems with what? Compatibility with the client system. Okay? With the what? With the client system. For instance, if you have a using the old version of Windows, let's say Windows 98, Pentium 1, Pentium 2, Pentium 3, and you want to use all the software that is not using any of that, is using Core i7 or Core i8, how do you work? That will not be able to, that will not be compatible with your system. Okay, that's another problem of all the software. Okay. Another problem with using all the software is the time it takes, okay, for staff to learn. Okay, you have to train your staff before they can use it. It's not something that you just pick and use. How many people can use? How many people understand? How many people can write SQL? They have to undergo training. These are some of the problems you have with using the audit software. But it has its own advantages also. One of the advantages is that it allows for processing of what? Large volume of data. You can process large volume of data. That's number one. Number two, there are less error. There are little or no errors when you use audit software. Because unless there is an error in the computer program that you have written, that will not lead to garbage in, garbage out. But if there's nothing like that, then there will be little or no error. Okay, that's an advantage of CAT or of all this software. Okay, hope that is clear. So we go on. Auditing around the computer. Now, when you talk about auditing around the computer, unlike the case of the audit software or CAT that is going very deep into the client computer system, when you're auditing around the computer, what you are saying here is that you're only checking the environment where the system is installed or the system is placed. Okay? You're only doing what? Checking the area or the environment where the system is what? Is installed or is placed. So the editor will be checking what? Input and what? Output only. You will not be checking the processing. You only check what comes in and what goes in and what comes out. That's all. The editor is not interested in what happens, how is that processing, how is that conversion possible. The editor is not interested. The editor will be interested only in what? Only in the output. But there are risks when you use the auditing around the computer. And what are the risks? You will not be able to obtain evidence whether the programs on the system are working effectively. You will not be able to conclude or to explain or to confirm that the system. Hello, is making noise again. Okay, you'll not be able to know because you're only working around it, you're not going deep. Then also, when there are discrepancies, when you're working around the computer, when there are discrepancies, it's become very difficult for you to detect or to reconcile because you don't know how the discrepancy occurred because you are not auditing inside the system. Okay, I hope we are getting it. So that is for that. The next thing we're going to talk about is directional testing. Okay, directional testing. Let me highlight what a directional testing means. What directional testing says is that it's a type of audit approach that explains the fact that once an error occurred on one side of the accounts or the financial statement, there's always a corresponding balance on the other side. That is, errors obey the principle of obey double entry principle. That is the simple and short of directional testing. Directional testing is an audit approach that supports the fact that errors obey or complies with what? The double entry principles. Okay? So some of the advantages of using directional testing are: one, it helps the auditor to clarify the audit objective. Okay? So what that means is that as an auditor, you're able to look through, right, and be sure that there are no material misstatements in the financial statement. Number two, it focuses the audit work on areas of high risk. So talking about directional testing, like I said, the auditor will be focusing on what? On the key areas of the what? Of the audit, of the client business. Number three, the directional testing combines the result of audit test. That is all the tests you have performed, the test of the transaction, test of controls, it combines it. Okay? It combines what? It combines it. I hope it's clear. So that is what we mean by what? Directional testing. Any question? Any question? Any comments? Are we together? Okay, let's continue. The next area we're looking at is analytical review procedures. ISA 520. It's ISA 520. Okay, not IAS, it's ISA 520. So it's a grammatical error or typo error. Okay? Now, I'll explain what analytical review procedure means. I said analytical review procedure shows plausible relationship between financial and non-financial data. All right. And one thing you need to note is that analytical review procedure is a supplementary type of audit evidence. It supports, it confirms. It's not the main audit evidence, but it lends its support. For instance, you wanted to buy stationery, and you saw that for this year, right, you spend 10,000 naira, or let's say you spend 50,000 naira. But you now check last year. Last year you paid maybe 10,000 naira. So you don't want to know what is the reason for that sudden increase in price. Okay? So it is a supplementary audit evidence. Okay? Then again, the analytical review procedure allows the auditor to assess whether reported figure makes sense in the context of known business facts. You can't just put any figure there. And mind you, talk about analytical review procedures, you're talking about three things. One, ratio analysis. Two, trend analysis. The third one is net changes. What do you mean by net changes? You look at your receivable last year, 20 million. Receivables this year has turned to what? 40 million. That means there's what? There's an increase in your what? Receivable. That means there's no proper monitoring. The only thing that can justify that is if your revenue has also doubled. If your revenue has not doubled and your account receivable balance is increasing, that means that in no time, the organization will be faced with what? Cash flow crisis. Okay? I hope you are getting it. So that is what we mean by analytical review procedures. Okay? So you can, as an auditor, there are three stages where you can use analytical review procedures. Number one, you use it at the planning stage. It's very, very important. You use it at the what? At the planning stage. Number two, you can use it as what? As a substantive procedure. You can use it as a substantive procedure. So you're asking question. Let me see the invoice for last year. Let me see all of it. By doing that, that's what we mean. Then number three, it may be used at the overall review stage. And when the auditor is done with the audit, right, you will now check whether there is consistency, okay, with the information that has been obtained and the auditor's knowledge of the what? Of the business. Okay? So that is analytical review procedures. Any question? So let's look at this question that explains analytical review procedures. It's analytical review procedures and the exam. An exam question may ask you to carry out analytical review procedures for an entity described in a small case study. The purpose of such a question will be to test your ability to identify unusual features in the draft financial statement of the client entity, or suggest what might be done to investigate the unusual figures more closely, or provide possible explanation for the unusual figures in the financial statements. Examples of unusual items in the financial statements that analytical review procedure would reveal are a substantial increase in sales revenue, but a substantial decrease in the cost of sales. Okay? A significant change in the gross profit margin. A significant increase or decrease in administrative expenses. a significant increase or decrease in selling and distribution expenses, a significant increase or decrease in interest costs or investment income. And lastly, a significant change in the net profit margin. Okay? So these are just examples of what you can use the analytical review procedures to achieve. All right? I talked about they are part of what? Ratios, okay? So you can use ratios and we use to assess whether the total recorded amount of payroll appears to be what? To be reasonable. You compare what you paid last year to what you paid this year as payroll or staff cost. It's going to open out or it's going to bring out so many information. Okay. Then other expenses also, the author can use the ratio to determine whether there is a need for them to cut some of those expenses. Because if you cut expenses, like what happened between Guinness Nigeria when it was being managed by Diageo, and now that it's being managed by Tolerant. When it was being managed by Diageo, right, Guinness made losses. But just within 8 months that Tolerant acquired Guinness, they have made profit. Okay, they have made what? Significant profit. So what is the difference? Maybe the style of leadership used by Tolerant is different. They are very conservative compared to when it was under Diageo. Okay, so those are some of the things you need to know about analytical review procedures. Any question? Are we together?
We are together, sir.
Okay. So,
Yes, sir, we are together.
thank you very much. Thank you for your time. Okay. So let's go to another aspect. So I've introduced substantive procedures. So, as a substantive procedure cut across every aspect of the world of the financial statement, right? So the first one we are going to look at is substantive procedure as it affects non-current assets. Okay? As it affects what? Non-current assets. All right? Now, and you know that, remember when we talk about audit risk, I made mention of the component of audit risk. One of them is what? Inherent. That inherent risk, that is, by their nature of some transactions, account balances, they are what? They are susceptible. They are prone to what? Manipulation. So if non-current asset is not properly evaluated or examined, right? There could be what? Material misstatement in the financial statement of the period under what? Under review. Okay? So there is that risk that there will be what? Material misstatement. All right? So, what are the principal risks of misstatement of non-current assets? Number one, there is a completeness assertion. That is, there is a risk that assets owned by the reporting entity have not been included in the financial statement. Because of what? Because they are trying to maybe to report that the company made a loss or the company barely what? Breaks even. Is a strategy by some organizations, okay? There is an existence assertion. That is, there is a risk that assets reported in financial statements do not actually exist or they have been sold or scrapped. That's also for what? For if the auditor does not go and check, they will just see a bunch of assets that are no longer in the organization that will be disposed of and still being left in the account schedule. There's also the valuation assertion. Now, if you look at all of this assertion, is in line with what we discussed earlier under the assertion based on what account balances. That's how you are going to know. So in case it comes out in the answer that what are the principal risks of misstatement in non-current assets? Just remember those assertions based on what account balances and just put the assertions there. Completeness assertion, existence assertion, valuation assertion, right and obligation assertion, and that's all. So under the valuation assertion, there is a risk that assets have been incorrectly valued, okay, or due to incorrect recording, inappropriate valuation, or incorrect what depreciation calculation. All right. Then you have the what right and obligation assertion. That is, there is a risk that the reporting entity does not actually own assets that are included in the what in the financial statement. Okay. Then the last one, there is presentation and disclosure. You know, I said that presentation and disclosure cut across the statement of profit or loss and what? The statement of financial position. So there's a risk that the assets have not been correctly presented or disclosed in the financial statement. Okay? So what are the substantive procedures the auditor will now carry out to ensure that these assertions or these risks are what? Are mitigated. Okay, you cannot eliminate this risk, only mitigate them. What I think the auditor will do. All right. So the auditor will carry out some of those tests. The first one is going to do is on what? On to test completeness, that there is no what? Understatement. They have not undervalued any asset, or existence, that they have not overvalued any asset. Okay. Then, so they are going to look at assets, because you are looking at non-current assets. So you're talking about what? Valuation. Okay, you're looking at what? Valuation. So at valuation, you'll be verifying amounts in financial statements with the valuer's report to be sure that they have carried out what? Evaluation, a report. Okay, you consider the reasonableness of the what? Of the valuation. How reasonable is the valuation? Thirdly, you are going to check that the valuation are regularly updated. You know, they said that IAS 36 says that you must test your assets against impairment at least once a year. Okay? Then you check the accounting for the rise or fall in value on valuation, as you check the adjustment on what? On the revaluation. In case of what? In case of assets valuation at cost. If you are looking at it from the angle of depreciation, you are going to review the depreciation rate for reasonableness in the light of the nature of the asset, the useful life, and the residual value. So, for instance, motor vehicle is usually 4 years. You go and motor vehicle as 1 year, or maybe motor vehicle as 7 years. How reasonable is that? Okay, ensure that consistent depreciation methods are in use. That is, you must check that they have constantly applied the depreciation method. They have used straight line method for the past 5 years. Not that they use straight line this year. Let's say they use some of this method. The other year they use reducing balancing method. No, they must adopt a depreciation policy and they must be consistent with it. Okay. Then the auditor will also review gain or loss on disposal. There are times where they sell assets, they sell off assets, they dispose assets. The auditor want to calculate and be sure that the value they have recognized as gain or loss on disposal is correct. Then there are times also you have obsolete assets. You need to test those assets. By the time you do the valuation, you test whether those assets are still obsolete or they have been impaired. All of these issues at the end of the day must be discussed with what? With the management. That is that the board of directors and the management. Okay. And some of the issues that are going to be discussed are what? The right and obligation, the ownership of those assets and liabilities. You need to also ask for the what? The title documents of the land and buildings. For vehicles, you need to request for what? Verify the vehicle particulars. Okay? Then other assets, you might need to look at the what? Their invoices. Okay? Review legal documents, bank documents, and other documents for evidence of any loans that are secured by charge on assets. That is, they have pledged on what? On assets. They have used assets as what? As collateral. Then, as the case of presentation and disclosure, the auditor must check that the disclosures that have been made concerning the non-current asset are adequate. Okay? They are what? They are adequate. All right? I hope we are together. So let's look at this. Let's look at this question. They said during the year ended 30th June, year 6, construction acquired freehold land at a cost of 500,000 and built a distribution center on it using a mixture of subcontracts and own labor. The distribution center cost a total of what? 200,000 to construct. The construction was completed by end of April. Required. State set out the audit objective in respect of the above and the substantive procedure you carry out to achieve the objective. Okay? How do we answer it? So the audit objective said the land and distribution center exists at 30th June, year 6. Okay? You need to visit sites and confirm that the distribution center has been built and is in use. Then construction owns the land and distribution center at 30th June, year 6. Then the auditor will also check the land registry for the certificate, whether the land belongs to the what? To the organization or to government. Then all expenses incurred in respect of the distribution center should be what? Should be capitalized. You cannot write them off, but you are looking at non-current assets. You need to capitalize them. Okay? Then you discuss with management their policy on capitalization or capitalizing expenditure. There's an organization, they will tell you that any asset that is below 100,000, we write it off at once. For instance, if they buy, what can we say, like if they bought a printer that is 100,000, you write it off in some organizations. And some organizations will tell you that anything above 100,000, anything above 100,000, they are going to do what? They are going to capitalize it. So it varies according to what organization. Okay? Then you need to review a sample of invoices not capitalized during the period and ensure treatment was correct. These are self-explanatory, right? Then the land and distribution center are appropriately disclosed. The must make sure that they properly make disclosure of this distribution center in the financial statement. And ensure that the schedule of costs, that is, all the costs incurred to build the distribution center, agrees with the balance that is contained in the what? In the financial statement. Okay? You can see this, you can see the procedure, right? Let's look at the last one, which is intangible non-current assets. Intangible non-current assets. So we need to look at the substantive procedure for intangible non-current assets. Okay? The same risk that we talked about, all those assertions, all those existence assertion, right and obligation assertion, valuation assertion, presentation and disclosure assertion, all those principal risks also affect this intangible assets. Okay. So it's the same thing that we talk about, all right? So what are intangible assets? Example of them, you have the purchase goodwill, you have the brand, okay? You have trademark, you have patents. All these are examples of what? Intangible assets, okay? So how do you carry out test of detail for purchase goodwill? One of the things you need to do, you need to confirm that the business was acquired. You know, most times purchase goodwill can only exist where there is what? Business acquisition. Business acquisition, or when there is what? When there is a takeover. That's when you talk about good. You thought we need to verify that, okay? The data we need to review the reasonableness of the valuation based on the what? Net assets acquired. The data we check the what? The calculation of the purchase goodwill. How do you calculate goodwill? That is the purchase consideration minus what? The fair value of what? Net asset. We give you what? Your purchase goodwill. Then review for the possibility of an impairment having arisen. That is, if there's an impairment on the what? On the goodwill. All right. Ensure that any impairment loss has been correctly calculated and recorded in the what? In the ledger. All right. So we also have what is called development cost. The development cost, I-38 states that an intangible asset arising from development cost shall be recognized if and only if an entity can demonstrate all of the following. You know, normally you write up development cost. You know, research and development, they are together. All right? Research and development, they are together. So it's supposed to be written off. Research and development is supposed to be written off. But you can capitalize development costs if these conditions are fulfilled. Number one, the technical feasibility of completing the intangible assets so that it will be available for use is there. There's an intention to complete the intangible asset and use it or sell it. Its ability to use or sell the intangible assets, okay? How the intangible assets will generate probable future economic benefits. The availability of adequate technical, financial, or other resources to complete the development and to use or sell intangible assets. The ability to measure reliably the expenditure attributable to the intangible assets during its what? Development. So once you can fulfill all of these conditions, you can what? You can recognize your development cost. And some of the other tests you'll be performing for development costs are discuss the development project with management, other relevant senior personnel, and other key stakeholders to assess the feasibility of the project and product. For instance, you want to make a product. You say you want to make, you want to go to the moon, like what Elon Musk is doing now, trying to build spaceship that will take people to the moon. So you want to see how realistic is that project. Is that possible? Okay. Review projections and forecasts for using resources and generating future economic benefits. You need to carry out a forecast analysis. You need to assess production and marketing plans and whether a market actually exists. Are there people that want to go to the moon? You can't compare Elon Musk project of transporting people to the moon in America when you compare it to Nigeria. Nigeria, nobody would like to go to the moon because there are other issues that are pending that are affecting us than going to the moon. Okay? Then, whether the entity will actually be able to use or sell the assets, you have to look at it. You need to discuss management intention to complete the assets and either use or sell it. Okay, you need to inspect development contracts and record supporting and safeguarding patents. Right? They have test control around the documentation and safekeeping of scientists' notes, discovery, and conclusion. Just like I said, the Elon Musk spacecraft that is trying to build, all the flow charts, all the scientists' notes, how they develop the manuscript, everything must properly what? Properly kept or safeguarded. Then test a sample of development costs for appropriate capitalization. Obtain little organization for management as to whether commitment to complete the project and either use or sell the assets. Okay? So that's all about the introduction to substantive procedure and substantive procedure looking at what non-current assets. Any question? Any comments? Any observation? So we are good, right? Thank you so much. So the next class we'll be having that is the last chapter. I'll be talking about chapter 14. That's the last chapter. But before then, the other facilitator will come and explain the other aspect of what substantive procedure. Okay, we will talk about the test of control before I come and wrap it up. I hope that is clear. So if you have try and practice questions, I'm going to pose some questions for us on this substantive procedure that can use as practice to see whether we have understood all that has been done today. All right. Does anybody have any question, comment, observation? Any question, comment, observation? Are we good?
Hello, sir. Hello,
Yes,
sir.
please go ahead. Please go ahead.
Okay. I just want to plead, can these videos be posted immediately? Because the last lecture, the internal control, right,
Control.
has not uploaded, and some of us, for some reasons, we are not consistent, for some obvious reasons. So we need this to back to
Okay. Okay. What you
track.
do? What you do? You know what you do for me? What you
Okay.
do for me now is immediately after this class, just
Okay.
tag Wasiu. You see Wasiu there, the guy, the administrator. Just tag him and say that they should upload this thing immediately. All right.
Okay.
That's the best I can do. I don't have the power to. What I can only do is also to send a reminder to the administrator, that is Mr. Wasiu, to upload it on time. I hope that is clear.
I had a chat with him today. We even spoke, and
Uh-huh.
he told me that internal control has been uploaded. I went to the link, and it has
Yeah.
not been up. That's since last week. So
Okay.
if that has,
Don't worry.
and there's been a constant reminder. I don't know when this will be uploaded, because this
Okay.
may
Don't
not
worry.
be the next class till after the next
Okay.
class.
Okay. So
So
what I will do is this.
feedback, please,
What,
sir.
okay. Don't worry. What I will do, I've taken your feedback. I
Okay,
will
sir.
also I will send a reminder to him so that there is for him that the students are yearning for the recorded lecture notes to be uploaded
Yes.
on time. I'll do
Okay.
that.
Thank you very
Any
much,
other?
sir.
Okay, it's a pleasure. Any other question, comment, observation? Are we good? Alexa, any question?
Nothing, sir.
All right. So enjoy the rest of the evening, okay, while you rest and prepare for tomorrow's activity. All right. Have a good night rest. Thank you so much.